Thank you very much for making to Philadelphia and to this session, which I'm really look forward to. So the keyword of the panel is fintech. It's a hot keyword, but does not really have official definition. So out of curiosity, I did 2 exercises to see what really people out there think what fintech is. So first, I went through all the Factiva articles in 2016 and 2017. And as long as there's a word fintech in the title, we try to see what the article is about, what the keyword's about. And it turned out there are over 7,000 articles just with a fintech in the title. And initially I thought about how about the article ever mentions fintech. And that turned out to be over 90,000 articles in the past 2 years. And you will see that the general audience out there realize that fintech is something that will transform the financial services for which the banking system has been the center. So this is a general audience, including everybody, mostly practitioners. Now, the second part is based on an endeavor at the Review of Financial Studies. So in early 2017, the IFS initiated a call for registered proposal, okay, which resulted in 8 proposals being accepted in principle by the journal at the proposal stage. Basically, the journal accepted the proposal in principle as long as the authors carry out execution as they outlined in the proposal. Now, the journal received 158 proposals in response, and when we parsed through the keywords of that call, and this is the keyword map. So this is the crowdsourcing of the wisdom among our own academic colleagues around the world to see what they think about the fintech is. And you see there's somewhat difference between what the practitioner think and what academic thinks. For the academics, seems we're particularly interested in information, the blockchain, and related topics. Okay? And I also will leave this question to our panelists and let them tell us what they think the key issues of the fintech is. So now I'm introducing the 4 panelists, distinguished scholars, today at site. So Susan Athey is the economics of technology professor at Stanford GSB. She was the 2007 winner of the John Bates Clark Medal and is elected member of the National Academy of Science. She's former consulting chief economist of Microsoft, and her research focuses on marketplace design and platform markets, and recently been working at the intersection of machine learning and econometrics. Maureen O'Hara is the Robert Purcell Professor of Finance at the Johnson School, Cornell University. She is a member of the Initiative for Cryptocurrencies and Contracts, which is a joint collaboration of Cornell, Berkeley, and Technion. She was the president of the AFA, the WFA, and FMA, and the pioneer scholar in market microstructure. Ken Harvey is the J. Paul Sticht Professor of International Business at Duke Fuqua School of Business. His research focuses on portfolio management, asset allocation, and global risk management. He served as the 2016 president of the AFA and was also a former editor of the Association Journal of Finance. David Yermack is Albert Fingerhut Professor of Finance Business Transformation and currently the chairman of the Finance Department at NYU Stern. He has been a leading scholar in corporate governance and recent years took up as a co-director of Stern MBA FinTech Specialization, a joint venture between finance and information systems departments. All the 4 panelists have been the pioneers in the classrooms of their respective institutions. Based on the numbers I calculated, last year, the 4 of them enrolled a total of 650 students in courses in fintech, blockchain, cryptocurrencies, and crypto ventures. According to a Financial Times article, Professor Yermack made NYU Stern the first major university to launch a course in the then nascent field of blockchains and cryptocurrencies in 2014. And at Duke, more than half of the class 2018 students took Professor Harvey's FinTech class. There are also several PhD students out of these supervisors who are currently on the job market with specialization in FinTech. And we only expect their 2018 enrollments going to increase even more dramatically. They are not only leading scholars within the Ivy Tower, but they also have contributed their thought leadership to the real ventures in FinTech. Professor Athey is advisor to the FinTech venture capital firm NYCA and a member of the board of directors of Ripple, a digital payment startup. Professor O'Hara is advisor to Symbiont.io, a blockchain technology company developing smart security platforms for institutional applications. Professor Harvey is the faculty founder of Duke Blockchain Lab, whose mission includes advising startup companies of blockchain applications. And Professor Yermack has advised a long list of government agencies on FinTech, including the Department of Treasury, the SEC, the US Public Company Consultant Accounting Oversight Board, and he also has advised a number of financial services companies, established ones as well as startups. Okay? So in one word, there's no better place to come if you want to hear the most edgy comments and overview about the FinTech space. So without further ado, I will give this podium to Professor Athey, who will talk about her view about FinTech.
Thanks so much for having me here. So I want to start out by saying I'm going to talk more about cryptocurrency and blockchain, but I think that FinTech is a much broader subject. And also, I just want to reiterate my disclosures. I'm in the board of Ripple, which is a blockchain startup that's got about 100 banks and counting that are using it for international payments. It also holds cryptocurrency, which has gone up about 30,000% this year, and is valued at over $100 billion at today's prices, although it's not liquid. So when I talk about prices, that disclosure is important, although my work precedes that run-up. And I should have also mentioned I'm on the board of Coin Center, which is an advocacy group for cryptocurrency, and they have a lot of educational materials on their site, so you should check it out for your teaching as well. Another point is that this is not just something that people can think about from a business perspective, but there's really a lot of great research opportunities here. I have 2 papers on Bitcoin myself, one on an experiment we did where we allocated Bitcoin to MIT undergraduates and evaluated their privacy preferences, and another I'll talk about a little bit in a minute. So in terms of first the question, what is FinTech? When you look at it from, say, the perspective of a venture capital company or what's happening in Silicon Valley, there's a bunch of areas that people think of as very active and having a lot of activity. Alternative credit, lending, advanced payments, all modernization of the payment system, digital advice, of course, blockchain. There's a lot of stuff happening on the back end that consumers don't see that is really having a big impact on the efficiency of our economy, called that financial infrastructure. There's a lot around AI, ML, and big data, although I would say that when you actually look behind the hood of a lot of what's going on, most of it is actually just automating existing processes rather than doing really sophisticated AI. It's really just at the very early stages. For most banks, most of their applications of AI are very simplistic. So that means there's a lot of upside opportunity in the future and a lot of business software and so on. There's many themes. Startups are creating new products and services, innovating much faster. Digitizing analog processes, still most of our financial system is basically like very badly digitized analog processes. And generally, we're also seeing the large institutions are worried about the fact that some of these new startups are acquiring consumers and helping them price compare or do other types of really getting in between the big financial institutions and their consumers. So those are some of the many themes. I want to take a few minutes now and just introduce the idea of Bitcoin and blockchain because I imagine some of you are very familiar, some of you less familiar, and so I just want to give like a 101. And many people's 101 gets into the weeds of the technology, and I'm just not going to do that because I have like 4 minutes to do this. So, but I think it's really the essence of what's going on. So the essence of Bitcoin is it's a big spreadsheet, a big ledger. And we can think about the spreadsheet or the ledger is being a very, very old concept. And so really what's new about blockchain is that we're going to have a way to keep that ledger secure, so that there's going to be a digital version of who has what, and that is going to be a final determination of who has what, and we figured out a way to make it digital and make it secure. So I could put up a big Google Doc that says, who has what, and we could all make entries on it, and I could say, oh, I owe you $5 for lunch, and I could make an entry there. But if there was $100 billion worth of value on that Google Doc, probably somebody would compromise its security. The key about Bitcoin is they figured out a way to do that, and basically through decentralized payment processing, which you can read about on your own time. So when you think about what you can do with this secure ledger, it's pseudonymous. Everybody has an ID, but we don't know who it belongs to. If I want to send a Bitcoin to you, then what I'm going to do is I can only do that if the ledger says I have one. So my address has to be allocated one on the ledger. If I want to send one to you, I authenticate and say, hey, it's me. I want to send a ledger to this other address, and then the entry gets made in the spreadsheet. And that's basically it. Now you wonder, what is all the excitement about this? But actually, being able to do things in a fully decentralized way has a lot of differences from our traditional system. Before I get into those differences more, let me just give you the very first question I asked when I got interested in this. I said, okay, this is great, it's awesome, but we all know as economists and finance people that exchange rate fluctuations are a bad thing. We have the euro to avoid that, right? So we have this massive industry trying to get around the problems of exchange rate fluctuations. Why would I want to introduce a new currency? So wouldn't it be better to put fiat currency on this ledger? And that really gets to a fundamental difference between digital currency and fiat currency, which is that I could have a ledger that said that I owed you $5, but that would be a promise, because a digital ledger can't physically incorporate a dollar. So just to be clear, I could have a ledger that says that this address has $1, I could authenticate, I could say I'm sending $1 to you, but it would just be a message because I didn't actually beam $1 to your keyboard. So if I wanted to do fiat currency on a ledger like this, they have to be IOUs. So there is no dollar on a blockchain. There's a dollar that's an IOU from an institution. And so what you could have, and actually Ripple, the company that I work with, has this on their ledger, you could have lots of different kinds of IOUs on a blockchain. So Bank of America and Chase could agree that they're both going to follow the rules of this blockchain. And Bank of America and Chase could agree that if I authenticate and say I'm going to send to you, they will, on the back end, move the money or shift the IOU. But that would be a promise. And of course, there's regulations and so on that say they might have to block that you can't know for sure that that transaction will really occur. And so really what's fundamentally different about the digital asset is that it is the only definition of the asset is the entry on the ledger. It's not an IOU for something else. It is that is the asset, is the entry on the ledger. And so that has advantages and disadvantages. If I send you a Bitcoin and I mistype an address, it's gone. There's no Bitcoin Corp to call up and send it back. Okay, so, and it's open source software, there is no Bitcoin Corp. So that is kind of bad from a consumer protection perspective. On the other hand, as an institution, it might be an awesome feature of an asset that I can actually move it and know with certainty it is gone and there are no chargebacks. That is a different kind of asset. It's an asset that we didn't have for international payments until this existed. So this is really the introduction of a new thing, that we can have digital contracts on it, we can move it digitally, and we can know for sure that the transaction is done. So it's kind of bad as a consumer product, but it could be great for times when you need that property. What can you do with this? Well, one of the early use cases of this is moving money internationally. It can take 2 weeks to get money to Africa. It can cost, the Citibank quoted one of my friends, 3% to move $1 million to Europe as a business customer. So it's very expensive to move money. What you could do with Bitcoin is you can take your Bitcoin, you can take dollars, put them on an exchange that accepts dollars. You can make an order for Bitcoin. You can buy the Bitcoin on an exchange, instantly send that Bitcoin anywhere in the world. The recipient can take the Bitcoin and sell it on an exchange and get their own home fiat currency. This can happen in a couple of hours, and there is no other way besides a suitcase and an airplane to get money to Africa in that time period. So businesses are actually using it for that purpose. But as you think about this exposes an end user to a lot of volatility. So my early prediction was this won't be a big thing for end users except in evading regulation. And really what you can do is you could use this as a back end and provide a consumer service that it insulates them from exchange rate risk, and that is something that's happened. Okay, so that's Bitcoin in a nutshell. I think that what you read about in the newspaper is Bitcoin is a store of value. It's the new gold. We should put money in it, and there's a fixed number of Bitcoins, and that's how we should invest our money. I think we all have good reasons to be skeptical about that. It's more interesting as a payment system for the reasons I just described. But really, what's happening in terms of the industry and then the applications is that it is a technology which can then be used to make lots of changes in the existing system. Remittances, asset registries, settlement systems, smart contracts, that's computer programs that move digital assets around as in a state contingent way, and other blockchain applications. And Ripple, where I'm on the board, as I mentioned, has connected more than 100 banks. And that's one thing they can do with it is move money internationally less expensively than the existing correspondence system. So just to take my last couple of minutes, I want to address an issue. I wrote a paper a couple of years ago in response to the basic criticism. Whenever I talked about Bitcoin, people would say, like, oh, this is just a bubble. There's no possible way you could ever value this. And I think what's happening now has a lot of those characteristics, so I stay out of the press on this issue these days. But I think generally, yes, you can think rationally about Bitcoin, and you can do research on it. So if you want to think about what's the exchange rate for Bitcoin, if we think about Bitcoin as actually having a use, or another digital currency having a use, where I use it to move money, then we can think about the number of digital currency units out there as the size of a pipe. And if I want to move money through the pipe, I can think about just supply and demand for that pipe, and then we can compute an equilibrium exchange rate. So if I want to send X dollars through B Bitcoins in a day, I can think of the equilibrium exchange rate as X over B. More broadly, I built a very, very simple but completely internally consistent theory model just to show how you could price Bitcoins. It's an infinite horizon model. There's some chance that Bitcoin dies, and you learn about that over time. The longer it survives, the more likely it's a good technology. Risk-averse users want to make international payments, and they use Bitcoin to move, or in the existing system has a fee. Using Bitcoin has both a time cost to figure it out, as well as exchange rate fluctuations. There's heterogeneous costs of using these Bitcoins. And exchange rates are set in supply and demand, and each time you get one, you just liquidate it right away to someone else who wants to use it for remittances. In this model, volatility decreases as more people adopt, which further reduces volatility. So we show in this very, very simple model, there exists a unique equilibrium with eventual full adoption. The set of costs, or the set of people that use Bitcoin, increases over time, and the distribution of exchange rate increases as more people use it for remittances. We then bring in speculators and investors, and those people push the exchange rates to their eventual steady state faster. We don't actually model bubbles in there, which would be an interesting and important thing to model. But this is mostly to say that you could, if people were going to use this for a purpose, there is a steady state equilibrium where the prices reflect the utilization. So it's possible this could all be rational. And we also we download the whole blockchain. It's pseudonymous. We can see what everybody does with everything. We find that most people buy and hold. The biggest identifiable use cases are gambling and contraband. And we also see that people try to obscure their behavior by using what are called mixers to prevent people from linking their illicit activity to their later holdings, and that increases over time. So I actually stopped this project. What I was thinking I would do when I started it is I would show this model that showed the prices of Bitcoin related to the utility use, and then while I was writing the paper, people would use it more for purposes like international payments, and then the model and the empirical work would hang together. What I actually found was that almost everything happening in Bitcoin was speculation, but people buying it and holding. None of the transaction volume was really using it for a purpose, or a very small amount. And so the model, my theoretical model, is not really a great fit for what's actually happening today. So I would say it could be. It's not fundamentally just all bubble and tulips, but if people aren't really using it for a purpose and they're mostly using it for speculation, then of course it's very hard to pin down when it's going to rise and fall and when it's going to crash. So just to conclude, I think that this is a fundamental technology. It enables things we couldn't do before. It creates assets that have properties that never existed before. It creates abilities to store and keep track of assets in ways that are very different than what we had in the past. And it actually has changed the banking system. So banks have started lowering fees, and 100 banks trying to adopt this new blockchain technology is reflective of the fact that they all believe that the speed of international payments and the fees associated with international payments are going to go down, and they've got to get efficient now. So even if they don't end up adopting any of this stuff, it has frightened them into innovation that people predicted just 5 years ago. They said it would take 15 or 20 years to change the system, and they're changing it now. So I think that we should all care about this. We should care about the inefficiencies and the lack of contractability and the lack of assets in the existing system. And we will see fundamental changes from this technology, either directly because people adopt it, or indirectly because people see, oh gosh, you could do this with blockchain, but gosh, there's a better way to do it. But the fact that we could do it with blockchain means some startup is going to do it, so I better do it too and get myself more efficient before I lose market share. So the impact will be there whichever way we go. And we can discuss all of these things more in the panel discussion. So thank you.
Thank you, Susan. So then we will have Professor O'Hara, talking about the nature of trading in the digital world, and she will also follow up on the transaction fees that the student just mentioned.
Well, thank you very much. I'm very pleased to be here at this FinTech panel at our AFA conference, and I want to congratulate Wei and also Peter, I think, for putting this session together, because obviously there's tremendous interest. And I suspect, like all of you, that we're all a bit both intrigued by and a bit overwhelmed by this area. And so I think it's a great opportunity to get a chance to look at all of this. Perhaps it's part of all of our New Year's resolutions to stay that much further ahead of our students. I want to start my remarks. I'm not going to use slides. I've actually seen Susan present before, and she has the best graphics. So the three of us knew enough, and we're not doing slides. So just remember hers. They were really good. I'm going to start my talk off with a rather famous quote from the evolutionary biologist J.B.S. Haldane. And this quote is about the process of innovation. And he describes 4 stages of acceptance for innovation. In particular, someone first says, this is worthless nonsense. Then the second stage, this is interesting, but a very perverse point of view. The third stage is, this is true, but quite unimportant. The fourth stage is, I always said so. So apart from Jamie Dimon, who I think is still somewhere around stage 1, I think the rest of us are kind of edging towards stage 4. But for the purposes of today, in the context of this discussion, I want to argue for a 5th stage. And that 5th stage is, this all seems really promising, but maybe there are some unexpected consequences we might think more about. Or put another way, the devil's in the details. And so I want to think a little bit about a direction here. There are a lot of directions on how FinTech will transform markets and services, and I think during our later discussions here, we're going to go far afield and talk about a lot of interesting areas. I want to focus on an area that I'm particularly interested in, the digital currencies and the nature of trading in the virtual world. And in my view, there are a variety of really interesting microstructure issues that begin to attach to what is now becoming bigger and bigger markets, if you will, for these virtual currencies. I think the challenges here will affect the future evolution of these currencies, and more importantly, I think that the issues here raise a variety of concerns relating to the stability of and risk of the broader financial system. So I'm going to take sort of a Debbie Downer role here and talk a little bit about some of these consequences that we're beginning to see come up, but also what I think are then some really interesting areas that we, as researchers, can begin to look at. So let me start with the microstructure of trading. An area I've worked on with some colleagues at Cornell is the dramatic rise in transactions costs on Bitcoin and other digital currencies. So Susan did a very nice job of talking about sort of how the Bitcoin emerges, and we have these miners, and you know, the double spend problem is solved, and that's very true. The challenge is that to actually get your transaction put on the block, you now have to append a transaction fee to your Bitcoin transaction or your Ethereum transaction or whatever. And this was essentially not in the original protocol. The miners were paid by mining fees, but it was envisioned this would eventually happen, and it has. If you put off your holiday shopping until Christmas Eve last year, you would have found that the average transaction fee on Bitcoin was 41 cents. This year, it was $43.20. If you were instead trading in Ethereum, the transaction fee last year on Christmas Eve was half a cent. This year, it was 89 cents. So if you're thinking of buying your Starbucks coffee with your Bitcoins, it gets a little pricey. And it really speaks to what Susan talked about. These things are not really being used for transactions. You'll find that, you know, there's a statement, there's 45,000 companies that take Bitcoin, but they don't actually hang on to it. They immediately get out of it, but they actually rarely get it anyway, so it's not really a problem. But it does speak to an interesting challenge. Why are these transaction fees going through the ceiling? And essentially, the main reason appears to be, and at least something that our research suggests, and others as well, that, you know, what you're getting now are traffic jams on the blockchain. And these traffic jams are creating difficulty because in a lot of ways, certainly the Bitcoin blockchain is not easily scalable. And that's an interesting challenge as it goes forward. Now, there are lots of other digital currencies. There are lots of other directions to go. But it's an interesting question. And it's leaning to the fact that Bitcoin cannot be everything to everybody, which is also the reason we're beginning to see all these forks. Because if you really want to use it at Starbucks, you're not going to want to pay the transactions fees that you're now finding. So you're beginning to see Bitcoin Cash. And there are other issues about other people unhappy who don't like other dimensions, and you're seeing Bitcoin Gold, and you're beginning to see fracturing. Now, from a microstructure guy, we see this all the time as we think about different exchanges. But it's a very interesting change and an interesting development. The bigger question, obviously, is what is the future of these currencies? Will we end up with many, many more? I mean, technically, there's around 1,300 or more. I think David may tell, as he talks about the ICOs, lead us down that direction. But the main ones are the interesting ones, to me at least, and it's going to be intriguing. Let me turn to the second issue here, and that's the exchanges on which virtual currencies trade. Much has been made about the security issues and those sorts of problems. It's certainly true that there have been several hacks now that are larger than the largest US bank robbery ever. So if you think these are safe, it's a little scary. For the centralized current exchanges, though, that are trading these things, I'm more concerned about the fact that there are no requirements that I'm aware of for proving solvency, both on their own and also as a group. There are also no rules on how exchanges operate, how investors are protected. And there's a reason to be concerned, given the incredible volatility. If you have Litecoin, for example, losing 50% of its value in a day, how does that affect the average investor as positions are unwound, margin calls are made, cast days of liquidations occur? These are challenges. There's also the hot wallet problem. This is essentially what happens when exchanges are connected to the internet, hold your funds in their infrastructure and their servers. So the first hack of the Korean exchange, Ubit, that you may have seen recently, involved exactly such a hot wallet hack. But the scary thing is their second hack, which caused them to declare bankruptcy in the last 2 weeks, wasn't a hot wallet. That was what was held off it occurred from hard wallets kept offline. Ubit's filed for bankruptcy. These security issues are non-trivial, but as such failures mount, what happens to the exchange ecosystem? And why does this matter? We know from other markets that when there's a problem, you sell what you can, not what you want to. So this event can lead to cascades beyond the entire virtual currency space and beyond. I think we've been seeing this happening recently, as you've seen these incredible movements in these virtual currencies. If if they're going to become a legitimate asset class, we have to move from being a virtually unregulated casino to something else. And in my view, this is too large and intertwined an area to ignore. Virtual currency exchanges are regulated as money service businesses. These are MSBs, and under US federal law, but we need changes, I believe. And I think that the CFTC has begun to recognize this. They're the regulator for the new futures, but they don't regulate the cash markets. And this is iffy. This becomes even more complicated because there's a new level of exchange coming up called decentralized exchanges. These decentralized exchanges, two of which are Ether Delta and Ox, are implemented entirely on the blockchain in code. So unlike a centralized exchange where users are going to deposit their funds, in decentralized exchanges, users retain control of their funds, and that stops the hacking problem. So that's the good news. But regulatory issues on these things now become huge because regulators will have to perform code analysis to ever check compliance. Are they ready to do so? I don't think so. An intriguing analysis of this exchange design by some of my computer science colleagues at Cornell argue that this design is very susceptible to front running. And again, why is this mattering? Because these are particularly well suited for these initial coin offerings that we're going to be hearing about. So as we begin to think about these underlying issues, I think it's really tricky. What will the future hold here? Not sure, but we have to sort out the trading and regulation of exchanges. I know I'm running out of time. I want to raise one final area before we move on, and that's the linkages to the banking system. Susan pointed out quite correctly that the existence of the blockchain is making the banking system innovate in ways that they probably wouldn't have, and that's going to be all to the good. But there's a linkage between this virtual digital currency world and the banking system that is more ominous. And it's reflected in something called Tethers and the Bitfinex mess. Some of you may know about Bitfinex is the second largest digital currency exchange in the world, is not in the US. Virtually none of these are in the US. I believe there's only 3 of these exchanges in the US, but there's lots of exchanges. Bitfinex is owned by a rather shady, I'll be careful here. Their corporate structure is a little vague. They're incorporated in the British Virgin Islands. There's another apparently owned company related with them issuing something called a Tether. A Tether is a digital token, and each Tether unit issued into circulation is supposed to be backed by $1 US. So you have these Tethers, which are virtual currency trading out there. The customers who want to trade virtual currencies through Bitfinex may deposit US dollars or Tethers into their Bitfinex account, receive the virtual currency, and then ultimately at some point they'll want to turn it back into US dollars. That's where the problem comes in. Because while the claim is that the coins are dollar-backed, the entity is unbanked. It's unbanked because essentially money laundering and other concerns caused Wells Fargo to cut them off. And so did all of the other Taiwanese banks they were dealing with. Now, again, is this just one little episode? There are 874 million Tethers. They're growing at the rate of 30 to 50 million a week and more. And these are US-denominated entities, currencies, that have apparently no backing. There is no regulation. It's not obvious how any of this works. But it does relate to the banking system because at some point you want to get out of your digital currencies into dollars, you're going to need some sort of transfer. These issues, I think, go to the heart of what I worry about. That you can begin to have an asset class that's almost totally unregulated that can introduce instability, not just in that asset class, but across. So will digital currencies transform the markets? I'm going to leave that to my other panelists to sort out. Despite my comments here, I think digital currencies, and in particular the blockchain, are going to be particularly important, and we'll talk about that later. Thank you.
Thank you, Maureen. So Professor Harvey will talk about the bubbles in the cryptocurrencies.
Okay, well, I would love to have the panel just mix it up, so I'm going to be brief. I've taught a course called Innovation in Crypto Ventures for the last 4 years. Indeed, it is not even a finance course anymore. It's got an unusual designation at Duke as interdisciplinary because my course is focused on blockchain. And while blockchain is very important for fintech, it's also very important for other areas of business. So very important for, let's say, operations in terms of supply chain mechanics being put on a blockchain. It's important for accounting in terms of real-time financial statements. It's important for marketing in particular. What happens to marketing when you all of a sudden have the ability to do micropayments? It changes the way that firms think about actually going out and marketing. So it's very disruptive for that field. And of course, for finance. Again, my course is mainly blockchain, maybe a third of it is fintech. And we see a lot of stuff in fintech that appears revolutionary, like mobile payments. That will be replaced eventually with blockchain-based technology. So what we're seeing is a lot of stuff that looks very innovative. I love using Apple Pay, but that uses the same backbone, the same 3% fee. It's brutally inefficient to pay 3% for any transaction. That will be a thing of the past with the evolution that's happening in terms of the payment space with blockchain technology. So those are all positives, but like Maureen, I'm going to be a bit of the Debbie Downer on this because I see what's happening today, and it's very concerning. So just recently, the most popular kind of broker or wallet, Coinbase.com, which is actually co-founded by Duke grad, they've got 15 million customers, more than Schwab. So a lot of people are just buying because the price has gone up. It's kind of the opposite as to what we teach, right? So basically these are bandwagon investors that have driven the prices of these cryptos up very dramatically. I tell people I don't give investment advice. Indeed, I'm not associated with any company. I hold some Bitcoin and Ethereum only for academic purposes. But
just sell it if you want to keep your balances down.
Yeah, okay. So what does it really mean? So I tell people, be prepared to lose 90%. In Bitcoin, 90% loss would take you back 12 months, right? So really not a big of a deal. So this is something that is extremely volatile. People claim that it's volatile because there's no fundamental value. Like for a stock, you've got cash flows, you've got risk, we can do present value. With this, there's nothing like that. So it's really difficult. So we can disagree on the value of a stock, and there's a range, but for crypto, some people fundamentally think that Bitcoin is worth 0, and others think it could be $1 million. Like that's disagreement. There's a massive disagreement. So it's no surprise that you see this volatility, but of course, at least recently, the prices have gone up very dramatically, and I do worry about that in terms of the implications. So people that are buying it for store of value, rather than what Susan was talking about and Maureen in terms of all of these really interesting other applications that could revolutionize a lot of the things that we do in finance. So that essentially, I do believe there will be a major correction. It's not hard to forecast that. And then many of these investors that are just in it because their neighbors in it, or the taxi drivers in it, they're basically abandon this and will basically go back to where we were, where a lot of people actually take the time to figure out what is actually happening and understand the currency and the mechanics behind it. And that is a challenge. It is a real challenge. To understand what's actually going on is a challenge. So one thing that really strikes me is it's not just about Bitcoin and Ethereum and Ripple. And one of the big things that's happened recently, and I'm talking over the last couple of months, it used to be, if you looked at the capitalization of all of the cryptocurrencies, Bitcoin was dominant. So 60%, 70%. Now it's a third. And that's good news for Susan. So basically all of these cryptos, and including ones that really don't make much sense, like Dogecoin, now has like over $1 billion in capitalization. It was proposed as a joke, based on a meme. So it's over $1 billion. It's number 35. So you see all of these currencies. You see ICOs, so initial coin offerings, or ITOs, initial token offerings. And the people that are proposing these often have no idea of the basics of blockchain technology. They're simply issuing a token because they know that they can raise money. And one story only. The Duke Blockchain Lab, what we do is we give some advice to startups, and it's a good thing for the students to get involved in that. So I got an email from a student at another school at Stanford University, in GSB, not in econ department.
I'm in GSB.
Okay, and basically, there's a blockchain startup, really exciting, want some advice, and they come to me, and I'm thinking, why not go down the hall and talk to Susan? But no, I decided to take the call, and I get hundreds of these, but I decided to take this one only because I could tell the story to my Duke students. So we hop on the call with the Stanford GSB student and then a senior person from this company, and they're intending to raise up to $200 million in an ICO. So we start to talk to them. So what is the idea? Well, the idea is we're going to issue this token, and we're allied with this very prominent firm in digital advertising. And this token is going to be used to pay for digital advertising. So, okay, so you could pay for digital advertising with dollars. Why do you need the token? So, well, we think we can raise $200 million. So, and that's the sort of analysis. And indeed, what they're asking is for people to prepay. So you need to buy the token now, and then you can use it over the next number of years for something you use dollars for. So the business model made no sense. I went on for maybe 20 minutes. I had a student in the office, and then after 20 minutes, the CEO of the venture came on, like 20 minutes late, and started to give the same pitch that the other person did. So I said, look, you're wasting my time. I've heard enough of this. There's nothing here. Goodbye, and just hung up. And the student was very impressed. So I said, well, that's it. That's the end of them. So about 10 minutes later, I got an email saying that they wanted to hire me as their how was it phrased? Their second most senior advisor. So I tell my student, okay, let's do some due diligence, and so we did the due diligence. So the CEO, turns out the CEO had been sentenced for basically spousal abuse, admitting that he kicked his wife 117 times. That's number one. So now I'm thinking, well, this person can't go to the bank for a loan, and they certainly can't do an IPO, so they're going to do an ICO, which is essentially unregulated. Okay, that's number one. Number two, who is the number one advisor? Paris Hilton. And what does she know about blockchain? You know, come on. So this is the state of the space right now. Yeah, I call it the Wild West of ICOs. People proposing these ideas that have essentially no merit. And this is kind of important in terms of some of the things that have been said earlier. We talk about the Bitcoin blockchain. That blockchain is very secure. So it is immutable. There might be forks, but that affects what's going to happen in the future. The stuff in the past is basically this unique record of history that is secure. I really believe it. In terms of the current computing technology, it's just infeasible to think about going back in time and changing that blockchain. However, not all blockchains are the same. So blockchain is a technology, and there's different ways to implement it. And one thing is that these thousands of tokens that are out there, most of them are not secure. Okay, so that means that history could be changed. And we've seen it in the past, we'll see it in the future. People implementing what they think is a public blockchain, some people implementing private blockchains that are flawed in terms of the security. So it's not just people going out and issuing tokens. They're issuing tokens with basically saying that it's secure and it's not secure. So maybe this is exactly what we should expect in terms of any innovation. So at the very beginning, there will be a shakeout. There's a lot of firms out there that are selling snake oil. And those firms might raise a lot of money, but the value probably zero. So I think it's important for us as academics and educators to give the foundation to our students so that they can actually take a look at this and see, well, what is the economic model? Does it make sense? Yes or no?
Thank you. Thank you, Cam. Professor Yermack will talk, and he promised that he will cover everything that the first three panelists did not.
I asked to go last because I knew it would give me the opportunity to disagree with many of the things that were said. But I'm remembering 2 years ago when Cam was the president of the AFA and asked me to organize a FinTech session. And at the time, there weren't 4 professors who could have been on such a panel. So we got people from industry. And I think about 75 people came, and we were more or less satisfied. But my expectation was if you came back in 2 years, you would see basically what's happening now. You know, there's, I think, 300 to 400 people here, standing room only. And I'm reminded of also a department meeting that I convened in my role as department chair. And we have a pretty good department, but I decided this was an opportunity to scold my colleagues and tell them that they were becoming irrelevant because students were not enrolling in our courses, and most importantly, recruiters were no longer hiring our graduates. And I told them simply that everyone over the summer had better learn what a blockchain was, and that within 5 years, all of them would be teaching it whether they wanted to or not. Because what you're seeing is a profound change in the nature of finance. I've come to believe that what you're seeing today is equivalent to the arrival of double-entry bookkeeping 600 years ago in terms of the before and after impact. And the mistake a lot of people make, and I think this may even apply to some of my colleagues on the panel, is to look at the transactions and the institutions that are being created and to try and view them through the lens of things that we already have in the markets. So Maureen's point about exchanges being unregulated and about them being offshore, I think this is correct, but to even try to compare them to the exchanges and think that the CFTC or the SEC should be regulating them or has the capability to is perhaps misplaced. What is happening is people from first principles are reimagining from Satoshi Nakamoto and Bitcoin, what is the nature of money? And from ICOs, what is the nature of venture finance? I think Susan's organization, Ripple, is perhaps the most successful application so far, which is how should we be doing international remittances? But really, you can go across the financial system and identify what some people call pain points or points of obvious failure. In terms of the equity markets, it takes until recently 3 days and now just 2 days to settle a trade on the New York Stock Exchange, which is really shocking. And there's a new organization called T0, which aims to do this in a matter of seconds using a completely different blockchain approach. International remittances can take 2 to 3 days and cost 7%, even if it's from New York to London. Ripple can do this virtually for free, again, using a totally different technology. The needs of consumers are the same as they've always been, but the technology and the institutions that are being brought into the market to address them are so radically different that they really aren't going to be understood and are not capable of being regulated by the governments and institutions that we already have. This, frankly, is why I began to teach my course. I teach it in conjunction with faculty from the law school, and we focus very heavily on regulation and not only the gaps, which are considerable, but what are the opportunities? How should these things be taxed? Should there be consumer protection? I think the popularity of these is clearly responding to a frustration on the part of the public that thinks that a lot of the regulation that we have is needlessly costly, sometimes counterproductive. A lot of these assets exist offshore, and they have to be regulated not by any sovereign government, but on an international basis, if at all. And it opens up many problems and points of concern, but in the end, there's huge opportunities. Let me just point out 2 issues, and then I think we should open this up. One is that I think the killer app that may be coming sooner than people think is central bank digital currency. And I was a little surprised by Susan's remarks about how money is just an IOU on a ledger. This has been true for a long time, and it was you who pointed me toward this article of money as memory that made me completely reconsider what is the nature of money. But you've seen just in the last month some pretty strong announcements, both from the Chinese and from the British, that we may be seeing them convert to central bank digital currency within the year. And I know that pretty much every leading central bank in the world is looking at this. And the irony here is palpable because Satoshi Nakamoto designed Bitcoin to put the central banks out of business. But when they co-opt it and make it their own business model, whomever Satoshi is, and maybe even somebody in this room, but I think there'll be a good deal of horror that the Federal Reserve and the Bank of England and so forth are the people using the blockchain to achieve a degree of hegemony and regulation that just wasn't possible in the old system. The other thing is that I would just remark that whatever field of finance you're in, this is important material. I don't think fintech is a standalone subject. Instead, it's a different way of looking at all of the finance that we already have. My area up until a couple years ago was corporate governance. And I now look at problems like the governance of mining pools, the governance of companies that may be issuing equity not on the New York Stock Exchange or NASDAQ, but on these new problems. The governance of central banks that now have blockchains that may put the fractional reserve banking system to bed. What will it mean when auditors don't exist anymore, which I think is probably well within 10 years. Many governance problems are solved, but obviously new ones are created by this technology. And I think whether you're working in microstructure, banking, asset management, any field of finance, it's a very exciting time because of the opportunities that the technology presents. And what we're doing at Stern is very methodically going through our curriculum and remaking courses one by one, things in risk management, banking, portfolio management. These are courses we've been teaching for a long time, but are redesigning from scratch to take into account that there's a very profoundly different technology that is of great interest to startups, to companies who want to hire our students, but
really of great interest to the legacy companies that are threatened for the first time by it. And I think many of them are going to be gone in 5 years, and they realize this. And I think we have to prepare for, one way or another, a period of a lot of change, but change that gives great opportunity for both academics and especially for consumers and businesses in the real world. So I'll stop at that point.
Thank you very much to all panelists. I think in the spirit of the panel, I'd like to first ask some follow-up questions, and then we will open up to the floor. So I learned from our 4 panelists that seems cryptocurrency, notably Bitcoin, is both a form of money or a form of payment, as well as asset or for investment or speculation. So we kind of used to the notion of money. So the money is to measure value and to serve the mean of payment. That kind of require that the value per se to be somewhat stable, which Bitcoin is not. So I'm just curious to know from a panelist to see whether Bitcoin is heading to that direction. And relatedly, we are all students of finance. And we couldn't help noticing the many bubbly properties of this cryptocurrency space. Basically, virtually a vertical rise of price with the underlying business purposes very hard to understand to most people. And also analogous to the shoeshine boy giving stock tips to Joe Kennedy in 1929, alerting him the pending burst of the stock bubble at the time. We also see cab drivers and probably all your family members are talking about Bitcoin and be surprised why you study finance, you didn't invest in it. So I also wonder whether is there any reason to believe, despite all these properties, actually not a bubble, or if it is, what will be the post-bubble landscape of this direction, which also seemed to be inevitable. So, okay, Cam.
I'll answer just part of it. And that's on the volatility. And it's kind of linked to what David was saying, in that one advantage the central banks have is that they solve the volatility problem, or at least the developed central banks. So the volatility, US dollar, let's say on an annualized basis, 6-7%, Bitcoin, 90%. Okay, so it is very volatile, and it's just not obvious. People have said, well, when there's more liquidity, the volatility will decrease. Well, there's been more liquidity, and the volatility hasn't really decreased over the last few years, at least. So I do think the central banks are definitely looking at this. And frankly, just think about it. Does it make any sense whatsoever that in the future we'll have a paper currency? That will be a relic of the past. All of the major central banks are working on this. And digital currency, that idea's been around since the 80s, but all of the initiatives failed. And they failed because digital, you can make a copy. You can make a copy of a video, music, a book. So what blockchain does is makes it impossible to counterfeit if the blockchain is a secure blockchain like Bitcoin. So there's many advantages here. It doesn't make any sense to me. The paper will be around in the future. Paper is anonymous. It's no surprise that 79% of the value of US currency is in $100 bills. 79%. And how many of us have hundreds in our pocket? Right? So it is basically used for crime. Okay, so you eliminate that. The people that study monetary economics love the idea also, because you can actually implement things like negative interest rates. Right? So negative interest rate, they're hard to do today, because you hold cash, you get a zero return. So if everything is a cryptocurrency on a blockchain, then you can do what you want. You can implement Milton Friedman's famous helicopter drop with a line of code. Okay, everybody gets $1,000 or 1,000 Fed coin, whatever you want to call it. So again, one of the advantages that the central banks actually have is the volatility, and I do believe it is a weakness of the current group of cryptos.
So actually, let me start out by addressing that issue and then come back to your question. So actually, national digital currency is also one of my very favorite topics, and I think I want to really highlight it here because I think there is a really interesting and important research agenda that we all have to start on now, like today, to solve this problem. So when I talk about this, I usually start with saying what these two said, so what they said, and then I say a few more things. So first of all, Ripple just had a day-long conference for central bankers working on cryptocurrency, and I completely agree. Everybody's thinking about it, and it will happen for sure in some countries relatively soon. And broadly, we will get, at least some countries will get rid of cash in the next 20 years. And then you have to think about, gosh, what all does that mean? And that's why there's this huge research agenda. So let me just raise a few issues. First of all, if we get rid of cash, then you also get rid of financial crimes in principle, tax evasion, as well as you can tax savings. But if you take that very seriously, then you also realize that you actually can't quite get rid of cash, or at least you can't, because we are not, as societies, 100% going to accept having all of our financial transactions actually monitored by the government. And so if we try to do that, and we don't preserve privacy, then there will be alternatives, whether it's $100 bills or gold coins or boxes of laundry detergent or all the other things. Literally, boxes of laundry detergent are used as currency in some countries in the drug trade. So we will find some other thing to use for under-the-table transactions. So just that by itself, thinking about, all right, how are we going to architect the privacy and security of national financial systems in the absence of cash? How are we going to balance wanting to have the government surveil versus if we surveil too much, that will increase the usage of alternative private things. So that suggests both a research agenda on more private blockchains that actually guarantee privacy, which there are some like this already, as well as a policy agenda on how we want to think about surveillance. And of course, in worlds where we're not sure about our governments, that can be frightening, in fact, for people. And that may be the biggest thing that delays the advent of these systems, is people's fear about surveillance. So, and that I think also speaks to some of the issues Maureen raised about the fact that I think some of my early colleagues who were excited about blockchain in industry would stand up and say, network effects, network effects, network effects, it's going to be Bitcoin, Bitcoin's the new gold, all the developers are committing to Bitcoin, and so there's just going to be one thing. And I was always the curmudgeon from the very beginning saying, no, no, no. Like if companies are going to use software for purposes, they're going to want it to be customized for that purpose. And so we're really going to see lots of different ones of these with different properties. And I think that is definitely playing out. Now to get back to the question about volatility. In principle, the volatility doesn't have to be super low if people are using these tokens as a way to get from point A to point B. You get in and you get out. And so it just has to be stable for a few hours. Now, it used to be stable for a few hours. I've personally been making some transactions recently, and I sit there and say, okay, Bitcoin is too slow because it's going to take 3 hours or 4 hours to finish confirming when I go from exchange A to exchange B, and it has regularly moved 5 to 10% in that time interval. So Bitcoin is too slow, Ethereum's a little faster. But I have to be sitting there watching it, to receive the Ethereum and sell it if I don't want to be subject to these fluctuations. So at the current time, as a consumer product, even for moving in a few hours, it's not a very good consumer
Why
product.
don't you go off chain?
It takes effort, I mean, I wasn't really set up to do
15
this.
million people have Coinbase accounts, and it's instant.
No, I understand that, but if I have to move money to Coinbase, it takes Coinbase about 5 hours to confirm my Bitcoin movement from my offline wallet or from another exchange. So, I'm suddenly like playing slot machines, and I'm really not the kind of person who plays slot machines. I hold index funds. So it's kind of a crazy thing.
And Ripple.
And Ripple, which has something to do with why I'm moving money. So, but so this is really like not a great consumer product. Now, I think a lot of people, which goes back to the main thing consumers are doing with it is gambling, basically. Now, you can provide services that insulate consumers from that for the purpose of like some of the payment companies or remittance companies that are using Ripple as a backend, and their consumers never see that risk. And I think that's really the consumer service that makes sense in the long run.
Maureen, David, have anything to add?
I'll just, I'll have comments, and as you know, it's always really hard to control academics, right? And so I just thought I'd want to just comment briefly before I comment on this. You know, I agree with David that this is a brand new world, and I do agree that some of the things that are changing are fundamentally changed, and even in trading, and clearing and settlement is going to change dramatically. But, you know, the challenge that I think we always have in finance is that it's important not to forget what we already know. And what we already know is when you have fraud and unfairness, eventually things collapse. And so I think part of the challenges we're seeing right now are some of these issues of, you know, the good news is it's decentralized, unregulated, whatever. It's also, at the moment, being manipulated by wash sales, insider trading, all kinds of issues. And that goes back to, what is this thing really worth? Bitfinex, the second largest, has been widely accused of using wash sales to drive these prices up and down and up and down. And at the end of the day, I think we will run out of people who simply want to hold a currency that is manipulated. Having said that, going back to the issue of the notion of central banks, I think here the issues really become intriguing because you see countries like China, which has shut down a lot of the digital exchanges, in part because they can't control their currency, because everybody can go around it using their currency controls using a digital currency. And so I think it speaks to Susan's point. We're not, I think, going to go back to a world, even if the central banks come in and introduce digital currencies, which does seem like a good idea at some point, you're still going to have these giant digital currencies because there are going to be advantages to them. They are very difficult to regulate. And, you know, so this future, again, goes back to the devil in the details. I'm not entirely sure how it plays out. Right now, if you look at who's actually buying a lot of the digital currencies, particularly Bitcoin, it was in China until they shut down all the exchanges. Then it moved to Japan. Now it's a lot as Korea. So it's not necessarily the person next door, unless you are lucky enough to live next door to a Korean. It's much more of an international thing and that makes it very challenging here in the U.S. to necessarily feel like we have a good feel for where this is going.
You know, the bubble question I get asked all the time, and privately I've felt probably since 2013 that Bitcoin's in a bubble, but have never actually taken that stance because it turns out I would have been wrong, and I'm glad I didn't. But before you answer that question, I would like my colleagues in asset pricing to give me a concise definition of what is a bubble. Ever since I took asset pricing with the great Professor Merton, I've been looking for the answer to this question and have not found any academic guidance one way or the other to what a bubble is and is not. So whether Bitcoin's a bubble, I have no idea because I don't know what a bubble is. The fraud part, I think, is very interesting. And most famously, Jamie Dimon, the CEO of JP Morgan, declared that Bitcoin was a fraud in September. And he was widely ridiculed for this, you know, even by people within his own organization who, you know, pointed out all the blockchain stuff that JP Morgan is doing. But whatever Bitcoin and these other cryptos are, they're not frauds because they are open source code that anybody can look. The disclosure and the transparency is extraordinary. And anybody who wants to can look at the code and inspect it. Not that everyone has the capability to do this, but a fraud implies some sort of omission or deception. And whatever else is going on here, the transparency is so high. When you talk about these wash sales on other exchanges, we can actually see them and we can document that these are going on, which is quite different than having them going on covertly and just suspecting them. There were Chinese exchanges that were just bouncing Bitcoins back and forth between each other, you know, in ways that mobsters do with New Jersey real estate. And the difference is that you could see it in China. And the point about outlawing this or banning this, you can't do it.
The volume in Korea and Japan is Chinese tourists who are simply catching regional flights, and what's going on is capital flight from China for very understandable reasons. Their banking system is insolvent, and they're very worried about this. But they can't solve that problem by just banning digital currency, because the only way to really do that is to shut down the internet. I was supposed to speak at a conference in Shanghai on initial coin offerings in October, and they told me I would have to change my topic, that it wasn't allowed to come talk about this. And so, yeah, I was suppressed politically by the Chinese, and I simply refused to come to the conference, but their idea of regulation is just to forbid people to talk about it. And as one of my colleagues then said in an email, if the Chinese are banning this, it must be pretty good. So,
just briefly, so on bubble, we kind of think of bubble as some large deviation from fundamental value. And the problem, as I already mentioned, is how do we measure the fundamental value?
yeah, what's fundamental value?
Yeah, exactly.
Yeah.
And you could argue even the US dollar, given any fiat, doesn't really have a fundamental value. But again, I think it's really hard. People talk bubble. I think everybody knows what we're talking about. It just seems like a price run up of 30,000% and Ripple. That seems a little extreme. Well,
wait till next year, Cam.
Yeah, exactly.
It has a use.
But one interesting idea that I'd be curious as to what the panel thinks about this. One way to get rid of the volatility is to take a different approach. We talked about like a Fed coin or something like that. But there's no reason that it has to be a central bank coin. You could actually collateralize. So there's a coin called RMG, which stands for the Royal Mint Group, in collaboration with the CME. Basically, they've got a vault in London with 1 million ounces of gold, and they issue RMG tokens against that gold. So effectively, when you hold this token, it's on a blockchain. This token has the volatility of gold. You need to trust that the gold is actually in that vault, and most people trust the Royal Mint Group. But essentially, you transfer the risk, and it allows people to have in their wallet not just Bitcoin or other cryptocurrencies, but things that are actually collateralized. So you could think of checking out at Whole Foods and paying $40 of groceries with gold. And if you actually think beyond this, there's no reason that you can't expand the menu of collateralization. So maybe there's another vault with 1 million shares IBM. What does that mean? It's kind of the ultimate explosion of dark pools. So almost anything can be adopted to a blockchain-based technology. And indeed, I never thought this possible, but this technology essentially allows us to think seriously about barter in the future. Okay, so operationalize barter with crypto tokens.
So I guess I still think that there's a good reason to have something that's doesn't require double coincidence of one, like barter. But I think this collateralization idea, I actually also in the I told you so part of the innovation chain. So I was proposing that back in 2013 as well. And I was very happy to see some of these companies start to do it. Now, with one of these companies, they lost their bank account. So we do need to think about the role of regulation there, in the sense that if we thought that it might be helpful for somebody to have a bank account and to be having their bank account audited, but then the bank account goes away because of regulation, and then it moves offshore, that is not necessarily helping consumers, and certainly not specific consumers that are associated with that company. I think that one thing I want to also highlight out of this previous discussion about the capital controls is that if you want to make a bet, I'm not going to tell you any investment advice about any cryptocurrency, but if I could short capital controls, I would short capital controls. Because it really seems like it's just not going to be possible to maintain large-scale capital controls in the future, because you can't shut down Bitcoin. And even if you don't fly from China to Korea to try to get your capital out, you can still exchange physical goods for digital currency. So you could think, people used to go around, they'd go to Miami, get a suitcase full of $100 bills, bribe the customs agent, come back, and then exchange $100 bills in a capital control country. Now you can skip the trip to Miami. Because you can just take, some sort of local good and have your phone right there and show the person that you're giving them a Bitcoin. So here's someone who's selling, fruit. They're getting paid in a Bitcoin. It happens instantly, so you can do it on the spot while you're physically standing there and make sure you got paid. Then you could take that Bitcoin and you can move that Bitcoin to any exchange in the world. And if it's a small amount, most of them will allow you without a lot of KYC, if it's under $1,000. So you could take that Bitcoin and put it in an exchange. And then 5 minutes later, you could sell that Bitcoin for dollars. So basically, anybody in the world, instead of putting a $100 bill under their mattress, can hold $100 in, say, the Bitstamp Exchange's bank account, digitally. And then when they want to get it out, they take their dollar, they buy a Bitcoin, they send the Bitcoin back to themselves, and they buy fruit from someone else with that Bitcoin. So basically, so this is a substitute technology for gold necklaces and $100 bills stuffed under mattresses, both of which entail substantial physical risk, as well as transaction costs from bribing customs agents and so on. So I guess we generally are going to need to, if I was the dictator of a high inflation country, I would sort of rethink my policies, going forward. This is not sort of a long-term sustainable policy.
Thank you. So let me ask one last question on behalf of the researchers in the audience. I guess a lot of us are here to get some oxygen for new research ideas. So I'd like to seek our panelists' inputs to give a somewhat more direct hint or advice about what are the specific or broad research questions that will be important and viable in the fintech space in the foreseeable future. So David, you want to start from you?
Yeah. There are some very clear events that are worth studying, and one that comes immediately to mind is the listing of futures on the CBOE and the Chicago Mercantile Exchange, which happened just within the last month, was a real coming-of-age moment for the cryptos. And to see what this did for volatility, liquidity, the direction of pricing, not just for Bitcoin, which is the basis of the futures, but for the entire market. And what I'm working on at the moment, I'm studying initial coin offerings as an alternative to the IPO and looking at how these perform in terms of trading, investor returns, capital raised, underwriting fees, and so forth, to try to see if this really is a better way for entrepreneurs to raise finance, to benchmark the old and the new. I'm also hoping to do a program on remittances using what you're now seeing are bilateral channels where people who have a payments corridor, say from Hong Kong to Dubai, or maybe Paris to San Francisco or whatever, are just bypassing the SWIFT network and stripping off of the SWIFT network a very secure, private, high-volume channel where they can send money with vastly greater speed and lower transaction costs. I think there's many ways that researchers can write empirical papers that show that fintech has the opportunity to improve on well-known market failures and bad benchmarks. There's a whole theory side to this as well. The theory is not my comparative advantage, but I think obviously the theory of how these markets are organized, when new assets are created, where the demand for assets comes from and so forth. There's huge openings. It's very early days with a lot of low-hanging fruit and topics in almost every direction that you look.
Maureen?
I think there's, again, I agree with David on this, that there's, I think, a tremendous number of areas to think about. Despite there being so many different digital currencies, I think there's an awful lot of work that remains to be on how's the optimal way to structure some of these. Because the initial breakthrough here really is the cryptology that allowed all this to work. And I think there are variations on how this can be done. It's tricky, though, and I'm working with some of the computer scientists at Cornell because, as a finance economist sort, you sort of say, well, optimality would look like this, and they're quick to say, no, that doesn't work because that violates the security protocol, so no, you can't do that. And so it's kind of fun to begin to understand these different elements that come in, and I believe we're seeing a lot there. One thing I would note is that, we've been talking about these public blockchains. There are also going to be these private blockchains, and one of the things that's interesting to me as I look at where this is going and where down the road, where I think maybe the biggest impact is going to be, is that these blockchains are really, really good at things like clearing and settlement and knowing who owns stuff. And if, you all are probably well aware here in the US, even though you think you own stock, you don't actually own stock, right? All the stock in the United States, almost all of it, unless you physically got that share of Disney, it's all owned by Seed & Co., which is a subsidiary of the DTC. Amazingly enough, that was decided back in the 1970s. And so why does that matter? I mean, in principle you own it, but you own it through your brokerage, and the brokerage in turn has this account at Seed & Co. And one of the really intriguing problems this creates, right, is that at any given time, companies don't actually know who owns them. It's just remarkable. You've been on a board where you're in the midst of some sort of corporate thing, and it's like, well, who are our biggest shareholders? And the answer is, we don't really know. We'll know at some point when we get the report that goes from DTC to the broker to this to this. This is a crazy system, right? And as we think about where this is going to go, some of you may know about the Delaware blockchain initiative, which is that companies will now be able to incorporate directly onto the blockchain. And this is, I think, going to be a huge change and a long overdue change. Right? The problem with clearing and settlement is that you end up with counterparty risk. And the big challenge the big thing that this sort of use of the blockchain does is it's really going to dramatically reduce counterparty risk. And so how does that affect us as doing researchers? Well, interestingly enough, one of the areas that's going to be really interesting is corporate governance, right? You may recall the Dole Foods problem of a couple of years ago where there was a leveraged buyout and there was a lawsuit that the management sort of screwed the regular shareholders. There was a settlement, and then it came time to pay out the settlement. Well, there were 49 million shares proffered to be settled. Only the company had only ever authorized 36 million, right? How can this happen? It's a crazy world out there. So, I think one of the things we're going to begin to see is, think about all the problems that you have of phantom voting and those sorts of things. As these things get introduced, right, what can you do, right? What sorts of changes can we make to areas that are affected by clearing and settlement? I think if you start thinking about it, you'll realize I think there's actually lots of these. I mean, we've taken it for granted that stuff clears and settles and who cares, right? As long as it ends up where it's supposed to. Only it doesn't end up where it's supposed to. This is an area that I think we have done very little on, and I think it could be very important.
So that was very well put. And so let me just pick up first where Maureen left off. I think that most of us underappreciate the inefficiencies in the current financial system. I sat on a table once with a bunch of Chicago economists who, when I explained what Ripple was doing, they were like, well, I don't understand, why can't Bank of America and Santander just settle up their ledgers? Why do they need to go through clearinghouses? Why does it take 2 days to get from New York to London or Paris? And I explained that, well, of course it is technologically possible, but they don't do it. And that's a little bit awkward for us, where you have these, yes, of course, there are many ways that any two banks bilaterally could agree to move money between them instantly. But the fact is that all of the money that moves all around the world today, none of it goes like that, except for a few people doing it over Ripple today. But so the fact that we could imagine many ways for inefficiencies to get eliminated doesn't mean they will get eliminated. And so it really is radical to have a software that allows two banks to move money instantly. And that's what Ripple is doing. I know that the best because I've seen it up close, but it's 24/7, 365 instant settlement between banks. And so I think whether it's Ripple or other technologies, One big research area then will be, what are the impacts of moving from this system, which today a small number of banks make profits over the fact that every other bank moves through them in hub and spoke systems, and the fact that, to get to Africa, why does it take 2 weeks to get to Africa? Because you might go 5 to 7 hops to get from here to Somalia, each one a correspondent banking relationship, each one with fees, each one with a chance that wires fail. About 4% of wires fail. Companies like Seagate that have lots of suppliers have an entire department full of people chasing down failed wire transfers. And so when people say that, fintechs succeed by evading regulation, well, there's a huge compliance cost when your wire transfer goes through 7 hops and 5% get lost. But if they don't go through 7 hops and they move instantly and the information travels with the money, then you don't have to use those compliance costs. So, it's not evading it, it's eliminating it through better technology. So it's a little bit uncomfortable for us that the existing systems have these glaring inefficiencies with existing technical solutions. It's a political economy issue. Like, SWIFT is a consortium of banks that have to vote on innovation. Like, imagine your department voting on innovation. You probably can't even agree on your website if you had to vote. And so and of course, there's huge distributional consequences of improving the system, and that's one reason they can't innovate. So another aspect of this that's interesting from a research perspective is who are the early adopters? It's younger banks, smaller countries that are disadvantaged in the current system. If you're a small bank or if you're in a small country, you're disadvantaged by half a percentage point on a transaction because of the financial system. So those countries and those banks are trying to adopt in order to gain market share. So that's an interesting sort of IO question. And generally, we've seen already some studies, like when certain countries introduced consumer instant payments, like Mexico and the UK, there were studies showing that there were a lot more payments, more frequent payments when the payment system improved. So I expect we should see a lot more of that kind of research. Also, globally, the Gates Foundation it just introduced a protocol for moving money between different mobile payment systems in Africa. And that also it reduces frictions, which are very impactful on poor people. And remittance costs, can be like 20% of remittances, and there's like $1 trillion of global remittances. So those types of costs are really important. Another aspect of research I think is super important is bank regulation. So, you may not realize this, but like a fintech that has something to do with blockchain probably can't even get a bank account to pay their employees, because the banks won't bank them. And so our existing system of regulatory banks, the banks say, well, gosh, like in 3 years, my regulator could come back and punish me for banking this company 3 years ago. And so I'm just literally not going to even give them a bank account to make payroll. And so if you impose those kinds of costs on startups, no wonder they go somewhere else. And taking away a bank account of a company that's serving customers is also something. So we just don't have a lot of cost-benefit analysis. We don't have a way to tell banks, hey, you can bank these high-risk customers. The banks would love to say, hey, I'm going to bank them. They're in a special category. Hey, regulator, I'm banking them. Let's all agree that I'm banking them, and you're not going to punish me later for banking them. But there's not a lot of good ways to do that. And this whole cost-benefit thing actually comes into other parts of fintech as well. So if banks want to adopt artificial intelligence to help with various auditing processes they have, like say KYC, knowing your customer, anti-money laundering, they have human processes that are regulated. And so they can say, okay, my process is that this transactions come in, we have these flags, humans review them, and this way everybody agrees this is my process. And if everybody follows the process, I'll have 0 mistakes, because you have to have 0 mistakes. I could replace that with an AI that actually has a much lower actual error rate. And I could actually document using test data that this has a lower error rate. But that is a risk that the banks are not able to take because we don't have effective regulation of algorithms. And of course, there are real issues for algorithms, like are they stable? Have you updated them? Are they manipulable, right? So it's not that it's completely easy to regulate the algorithms, but at present, banks are using them for things like optimal character recognition and stuff like that, but they're afraid to use them in some of the areas where they would be most impactful because the regulatory environment doesn't exist. So those of you who are part of regulatory agencies or sending your students there, we actually need a new discipline of regulating blockchain and regulating algorithms generally. that actually has cost-benefit analysis as part of it. And it's not completely boring. Trust me, I can't tell you all the interesting issues now, but it actually is, it's intellectually interesting to figure out how to do that, and so I think it's a great area.
So one thing I'd like to emphasize is something Maureen said, and that's about the computer scientists. When I first got interested in cryptocurrencies, I began with reading the literature in computer science, and these people are incredibly talented. And Maureen's very lucky to be at Cornell, where some of the thought leaders are in computer science and blockchain technology. However, they don't know any economics.
That's true.
Okay, so there is a huge opportunity. There's ideas out there in computer science that can easily be taken into finance. There's so many possibilities. We've done this in the past in finance, looking to physics and other areas and adopted some of their ideas. This is a great opportunity for all of us. So many of the very interesting research topics have been covered already. Just let me mention 4 ideas. So number 1, and I mentioned this at the RFS conference, I think it's fascinating that something like Bitcoin exists in an environment where no trust is required. So that's very unique. And I've always thought that there could be an interesting research paper that kind of uses this innovation to essentially try to value trust. Okay, so that's a big idea, I think. It's a difficult idea. Number 2, and we've kind of talked about this already, how do we think about valuing a cryptocurrency? We need a new framework to actually do that. There's no research on this. You know, people do this accounting sort of approach where they look at the cost of mining and electricity to come up with some break-even level. That is not valuing a cryptocurrency. So any progress on that would be, I think, also a big idea. Empirically, cryptos are very interesting because they're not necessarily correlated with kind of known factors. So just because the stock market goes down doesn't mean the cryptos are going to go down. The sample is very short, so we really only have quality data from 2013, let's say. So we don't really know what would happen in a crisis, like a financial crisis. But it might be that the cryptos don't necessarily move or actually go up in value. So they could have some hedging properties that are kind of interesting. So we talk about the risk of investing in a cryptocurrency in terms of the volatility, but I think we need to look beyond the volatility and actually consider the fact that they probably have 0 or negative correlation with other assets. So I think that that's kind of an interesting empirical exercise to do. The last idea is another kind of big picture idea. And that is essentially where we're going is a world where transactions costs are driven very close to 0. So that's a good thing, to have very low transactions costs. But what are the implications of that? Indeed, when this happens, there could be many new classes of assets. So think of me as an investor, rather than buying IBM stock, I buy a piece of a cell phone tower. And somebody drives by that tower, makes a micropayment, and then instantly that, or part of that payment, goes into my wallet, into my account. Or maybe I invest in a piece of his self-driving car. And again, somebody gets in that car, pays the fare, I get my share instantly. So all of these new assets arise. So we have to kind of broaden the way that we think of a diversified portfolio. It's not a 60-40 world anymore with all of these assets, and these assets are available, importantly, to everyone, not just the institutional investors that have a staff to research things, but to everybody. Everybody's got the ability to invest in these things. Everybody has got their own bank account. So another big implication of this, in terms of my research in international finance, is you've got 2 billion people that are unbanked in the world. And we just heard this hard for even a startup to get a bank account. This technology allows everybody to be banked with their own bank. So I think those are some interesting ideas.
Thank you. So we have about 15 minutes. We'll open up to questions from the floor. So if you have a question, please walk to one of the speakerphones. And you can direct your question to a specific panelist or the whole panel.
Susan, you spoke about the issue of insulating transactions from FX risk. And it wasn't clear to me exactly what you meant by that, but is there a way by which one can reduce the volatility in international remittances?
Well, so one way to avoid volatility is just to have things happen very fast. And so that's part of Ripple's solution. And in principle, that's what the other cryptocurrencies were going to do as well. And in fact, you can also just have direct connections with alternative escrow systems and protocols. But basically, part of the problem of moving money internationally is if it is slow, then you are both, first of all, like a company like Seagate might have $800 million at all times that they call dark. It's dark because it's in transit from point A to point B, and that capital can't be deployed for other purposes. And it's subject to exchange rate fluctuations. So if you can just make it instant, then you eliminate all of those problems.
I'd like to have a question for all the panelists about what's the point of having a national cryptocurrency? Because as Professor Harvey mentioned, that one of the greatest feature in a blockchain is trust-free. So I don't have to trust Satoshi that the overall supply will be capped at 21 million. I can check it in the open source code. I mean, if you have a central bank to issue cryptocurrency, it basically still requires the same trust in the credibility of that nation to use that cryptocurrency. And just like Professor Harvey mentioned, we can do the helicopter money trick by just one line of code. So it's not sound money at all. So why, what's the point of having national cryptocurrency? Thank you.
I've published a paper on this recently, and I think Cam hit some of the high points, but there are many others as well. It's great to end tax evasion and end money laundering, but one of the real things that you want to get rid of is the fractional reserve banking system with the moral hazard problems and the periodic bailouts. We've never solved this problem. I have a slide that I use in class of what a bank run looked like in 1873 and what it looks like today, and now it's in color, but it's the same bank run that we had 140 years ago. And you can have everybody just bank directly at the central bank, and you don't have this whole infrastructure of deposit insurance and implicit guarantees and so forth. What we spend on shoring up the banking system is just mind-boggling. And to me, it's a long list of benefits that you get, but the number one is the right to just get rid of the fractional reserve banking system. This is obviously going to be bad for the banks, and you can expect them to resist it politically, but it's long overdue.
So I think just to think about like what happens to the industry structure of banks, probably if you had a national digital currency, you would have two types of banks. One would basically be wallet providers, which are regulated in terms of security, but there would be no risk regulation because you would basically just be a user interface between the user and the central bank. So everybody has an account with the central bank. Now, some people might like to receive interest, and that is part of the benefit of the fractional reserve system is that you get paid interest. So I actually disagree that that would go away. I think you would maintain that, but it would be for people with larger account sizes, and they would compete with each other. That would be my prediction. But it would definitely be a big change to the industry structure of banks, which is, in addition to the surveillance concerns, one of the, probably the second or maybe the first major reason that we won't see this happen as quickly as we might think, especially in countries where banks have a lot of political power.
Yeah, I can't. I mean, I love the imagination that leads us to see a world beyond the world we're in. And, you know, David's a little younger than I am, so it's possible he'll still be alive when that happens. But
It's going to happen this year, Maureen.
I'll probably live longer than David, so I'm not real sure about that. I mean, I think you raise a very good point, right? That governments have no limitation on the amount of a currency they can create. And one of the beauties of Bitcoin is that it's built to be deflationary, right? And that we've seen, for example, in Ether in the last couple of years, they have actually cut down on things trying to make it less inflationary. So those issues are interesting, and I think what it speaks to and what your question rightly, I think, forces us to think about is what are all the different aspects of currency and the different aspects of what a banking system does, which in many ways is, I think, rather complex. And you know, when everything else comes to pass and the cockroaches are left, I still think there'll be banks there. So that's my view.
But I guess, of course, I'll say the obvious, which is that the mainstream economic view is that there is a role for monetary policy, and so that you would like a central bank to be able to use monetary policy. Yep. Now, when I go to crypto conferences, that's a very controversial statement, and I think I've gotten booed for saying things like that in those conferences. But hopefully here we agree that there, at least if you have a responsible central bank, there is a role for monetary policy, which is why you don't want the world to be on Bitcoin. But if you have irresponsible countries without good governance, then there's a completely different discussion.
Yeah, imagine an irresponsible central bank. Do these things exist anywhere in the world? The one prediction I'm very comfortable with is that the U.S. will not lead this parade. I think the Federal Reserve will be one of the last central banks to go to digital currency, because our best export in this country is the suitcase of $100 bills. The point that was made earlier, that we would have to forfeit this franchise of money laundering and tax evasion that's extremely lucrative for the United States. And I think that will be a hard Rubicon to cross. It's not going to be something that happens overnight.
Ken Rogoff actually thinks that that's not true because of the benefits of tax evasion and so on. But yes.
It's an interesting research discussion,
yes, exactly.
And it really focuses the question on what's the salient issue.
Yep.
Yeah.
And probably the first country will be Sweden. Only 2% of their transactions are done in cash.
Yeah.
So it's just no big deal to move to a crypto. But one thing that's very important is to understand that these central bank blockchains, these are not like the Bitcoin blockchain. So Bitcoin, you don't trust anybody. There's a computer program, everybody can see it. The rate of inflation is clear. There's a rule, it can't be changed easily at least. When we move to a central bank coin, that involves trust. Okay, so you have to trust your central bank. And I agree with David that there's a difference in trusting Venezuela or Zimbabwe than the US. So there is trust. And one of the biggest mistakes that people make in using blockchain, deploying blockchain as a business, is that they believe that the blockchain needs to be a public, trustless blockchain, when often that's not necessary. So right now we've got some trust in the US central bank. So to go from that some trust to zero, that's a big move and probably not necessary in the short term.
So given the time, we'll clear the line of the three gentlemen so you can ask your question in sequence.
Yeah, thank you for the panelists for the thoughtful comments. I want to hear your thoughts on the derivative markets that is growing on the cryptocurrency, based on the cryptocurrency. So like, for example, if you have regular cash, you can use it to buy stocks or artworks as a store of value or as a way of investment. But like, there's some specific thing you can do with cryptocurrency. Like, there's an app called Crypto Kitties. You can use Ethers to buy cats that are digital, and then use that and resell that later on to gain more value of your investment. So wonder, do you feel there is more growth to that market? And what are the things you can do there that are different from what you can do with regular cash or paper currency?
Do you want all three questions?
Do you want all three to ask questions first?
No, Yes, you can all ask all the questions, then the panel can address you.
Thanks for the panelists for your comments. I have two questions. One is particular for Susan, another for Cam. And just for Susan is like, I've been reading like the white paper and the yellow papers of Ripple, and I kind of try to understand how Ripple works. One thing that I always have trouble is to understand what it's like its token, the XRP, what role it's trying to play. So maybe can you give us, from an economist perspective, why do we need such an XRP while we can actually just run such a ledger for Ripple? It seems to me like we don't necessarily need that. So this is one question. And then just for Cam, it's more like a comment, just like you talk about the crazy case about the ICOs. And my interpretation as someone who's actively researching ICO is that it's calling for an opportunity for us to look at what are the economic value behind ICOs, if there are any, that can help practitioners screen investment opportunities, and also for regulators to kind of ban maybe like those bad projects. This is my understanding. I just want to confirm with you whether like kind of aligns with what you see, or you just view it like very negatively. Thanks.
Thank you very much. So my question is, initially the Bitcoin is actually invented for decentralization, but actually right now the biggest Bitcoin holder is actually Bitfinex, which is a centralized, somehow centralized exchange. So how could we understand this gap? And is everybody actually using Bitcoin as just for its decentralization, or probably for its anonymous, or probably some other feature? Thank you very much.
So maybe I can take two of those questions and then turn it over. So the last one of just how people are using Bitcoin. So my data is a little bit out of date. If you look at my paper, which is on my website, I examined how people were using Bitcoin, and there's like these gambling sites where you can send a Bitcoin and then it's like a slot machine and you get it back according to certain odds. And there's things like Silk Road and its successors, which people used for contraband. But really, most of what people are doing with Bitcoin is going back and forth to exchanges and using it as a store of value and speculation. So that was kind of my original point, that I started a research project thinking that it would become more interesting than it was. And you actually said there's no theories of the value. Well, I actually presented one, and I wrote it up many years ago. It's a very simple theory of value. It just doesn't happen to correspond very well to a world where 98% of what's going on is speculation. And I think in some sense, for any asset that's mostly speculation, there's obviously multiple equilibria, and it's basically very hard to have a theory at all, which is why I've had 200 media requests to talk about Bitcoin prices, and I deleted them all. Because in some sense, I think it's just very hard to talk about it from a really academic perspective right now. By the way, you should all also, if you get, the reason the ICO guy went to him was that, I delete every email that has ICO in the title. I probably have gotten at least 300 of them, all offering me lots of money to be listed as an advisor. I've had friends who just responded to the email and said no, and then they were listed as advisors. So if you don't want to get pulled into a class action lawsuit about securities, you should delete the emails. But then the other question about XRP, so this is a little bit of the in the weeds, but Ripple is a company that does two things. The first is it provides software for banks to exchange information and move money between themselves, and that can happen without the blockchain. And this is actually a very common theme in blockchain, is that companies or startups start out thinking they're going to use the blockchain to solve a problem, and it turns out that while you could use the blockchain, you don't need it. And in fact, you might be able to do it better without the blockchain. And that's one of the reasons I say it spawns innovation, but it doesn't necessarily always end up there. The role of Ripple has a digital currency also. And this is actually another very interesting research area, is the hub and spoke nature of international payments. So today, there's a few banks that are basically the hubs. And if you think about how money actually moves, one kind of oversimplified abstraction is that you have a series of movements among one party who has accounts in two banks. And so those parties make internal ledger entries, and then there's a chain of these parties that move the money from A to B. And then but to simplify this, it's better to have a hub and spoke system where you go from, say, a small US credit union into Citibank, and then from Citibank to, Santander, and then from Santander to another credit union. So those are the kinds of chains that occur, and it's obviously efficient to have hubs. The problem is, if large U.S. banks are the hubs, that's going to mean that certain places are less well served if we have, for regulatory reasons, Citibank doesn't want to hold money in Somalia or other places. So you end up with very expensive routings in the existing hub and spoke system. So having a digital currency as the hub, where you can go from Bank of America dollars into XRP, and then XRP into Santander euros, which is this Santander has this functionality. That's one of the big banks using it. Then you can both get there faster, and then also the hub currency doesn't take a fee, and it's not giving market share to one of your competitors, and it can be more neutral internationally, and it has different risk profile. So going in and out of an XRP has a different risk profile than going in and out of a Citibank dollar. And it can have certainty and instantaneous the way that a US dollar and Citibank cannot. So who knows if XRP will be the hub or some other thing will be the hub, but my prediction would be that we will have blockchain assets as hubs in a hub and spoke system of international payments, and the main question is, what will it be?
So question 2B on the ICOs. So basically what I do is kind of the basic thing that anybody would do evaluating any company. You ask the question, what is the problem that is proposed to being solved? And is this problem an important problem? So you start there. If it is blockchain based, fundamentally you ask the question, do you need a blockchain? Sometimes a regular database would be fine. You don't need blockchain to actually solve the problem. And you also investigate what type of blockchain. So is it public, is it private, and also the security, as I've mentioned, is crucial. So that's the way that I view it. I also have hundreds of these emails about the ICOs. I don't delete them. I actually put them in an email folder and then use them as assignments in my course.
Not to say that there couldn't be some really good ideas, but just probably in both of our flows of 300 or something, they're mostly not.
I think ICOs are very misunderstood, though. People are viewing them as an end run around the equity markets. What the ICOs are trying to do is implement the Schleifer and Vishny stakeholder capitalism by giving some type of claim to the customers of a company. So Schleifer and Vishny wrote a paper in the 80s where they talked about labor as a stakeholder in the corporation. But a corporation really has many stakeholders, including the tax collector, and probably the biggest of all is the customers. And what the ICOs are really meant to do is to reward customers for loyalty and commitment. You think about an organization like Facebook, the value comes from the 2 billion customers, but all the profit goes to Mark Zuckerberg. And what you're really trying to do is to recruit customers by offering them a piece of the appreciation of the entire business enterprise. It's a very creative structure. It's not a security. The SEC has no business meddling, with a few exceptions, but most of these don't have dividends. They don't have voting rights. What they actually resemble are the personal seat licenses that you see in stadiums football teams construct. And I think it's a very interesting thing. Many of them will crash and burn, but it fundamentally reimagines the way that you can raise investment capital in a company.
I want to just add one comment about that. I think that in principle the idea is good, but the challenge is that essentially investing in something that has no obligation to share in those ultimate profits is really a problem here. And the SEC issue is a very interesting one. The case that just came down with DAO, where the SEC pointed out this is a security.
One case.
No. But I think the point is, and I think this is what's important is I don't believe the digital world will be as strong by itself than it would be if it can integrate with the rest of the economy. And the same thing's true in the capital markets, right? The capital markets will be greatly strengthened by the virtual digital world as it integrates into the capital markets and changes the capital markets, but won't eliminate them. I think that the SEC was kind of right to look at some of these ICOs and say, look, if it actually promises you fundamental return in a company, then that's a security. And we do have security regulation. We may not like it, but I think for that type of ICO, that's what we should have. And for the ones that just let you do it because you want to be part of something, feel free. But you should know what you're getting into.
And I think partly this is an empirical state. I completely agree that it's a fascinating corporate governance question. It's a great research question about all the things that you could do differently with an alternative structure. But then the empirical thing that's happening is 200 people are emailing me with business plans that are like a 5-page white paper they cranked out, and they're selling these coins and raising $100 million and then walking away with it. So like at this moment, you know, it's not a great thing to be associated with. In fact, I hope nobody tweeted me already, because my goal is to never have a sentence that has Susan Athey and ICO in it. I don't want to be in the movie about this later. But it's not to say that it isn't intellectually interesting and doesn't have a lot of potential. It's just that the thing that's happening right now is problematic.
And why did Cam walk off the stage?
Yeah. So I really learned a lot during the past 2 hours. I hope that you feel the same. But I have to announce that this brings to the end of the session. Let's give a round of applause to all the panelists and the audience. Thank you so much.